So as I mentioned at the outset, one of the things we wanted to explore with our panel is this whole issue of corporate reporting. We previously talked about is more or less. And, as I was listening, Cameron, and I was thinking about IFRS, of course, there was a lot more disclosures coming on board with IFRS. Your example, shows that more information needs to be required to meet investor needs. But at the same time, you get feedback from stakeholders in terms of investors, directors and so forth saying, these reports are getting so voluminous and there's so much boilerplate, which you were arguing against, that we really need to get something fixed. And the question is there enough motivation? Is the system really broken? Mm-hmm. Is there a motivation to say, yeah, we do need to clean up the financial statements. We need to take a look at the MD&A. It's a very powerful document if it's used properly. But is there a sense around this group that something needs to be fixed on that front? Patricia, and Cameron, I'll get to.
Well, there is a sense that over time the documents have become more and more thick in terms of information that it's just thrown. And we're trying to put the whole kitchen sink in terms of information there. We're doing this, the management, the board is doing this or accepting this in terms of protecting themselves and not necessarily having a true discussion in terms of trying to define the fine line in terms of what is acceptable to be born or presented to the public versus what is more for information purposes. So that's one thing, but this is a trend that went probably overboard. Now we probably have to try and diminish that. But then you have the other swing in the market where you have these shareholder activists that are, pinpointing and taking actions on information that was probably not properly divulged. So, the board is really, and the management and the auditors, we're all in the same, obviously, group trying to define where's the right line and where is the right position to park ourselves going forward.
Cameron.
Don, my world is financial statements, obviously, and I can talk a little bit about that. I think there's two things that we need to think about. There's a cultural aspect to this, and there's also standard setting that is in play here. And I think both of those things are moving in the right direction. I think culturally we have to think about what's the right mentality in producing financial statements. And the mentality I think about the financial statements is that they should be looked at as a communications document and not a compliance exercise. If we can get to that state of culture, I think we're going to make progress. On the standard setting side of things, a lot of progress has been done, and we already have tools in our arsenal on this topic. It's called materiality, and the actual standards, IFRS, does say that you do not need to include information that's not material. The standards have recently been amended to actually go further and say that you should not be including immaterial information that would obscure material information. So I think this is a broad issue. It's not just one party responsible. It's not just management. It's not just the audit committee. It's securities regulators. It's standard setters. It's audit oversight body. It's the auditors to think about what really is important information for investors to have. And that, if we all embrace that concept, it would trickle down to management making those, being willing to make those determinations of materiality, having the courage to make those determinations of materiality, not including things that are just obscure. There may be a requirement there, but if it's not material, why include it? And then the audit committee being on board with management to embrace the fact that they're willing to take on that challenge of omitting information that's just not material.
Well, there's no doubt that sea change, cultural change around as a key thing, and then the courage to push that forward. But Jim, you sit on audit committees. Is there momentum? Is there a belief that, gee, we need to change, things need to get better?
Yeah, and what I'd like to do, Don, is pose a question back to you and the panel. So let me give you a quote. Ray Groves was a former chairman of Ernst & Young in the United States, I think he was chairman of the AICPA, very, very distinguished man in the profession. And he expressed a concern that the quantity of financial disclosures has become so excessive that it diminished the overall value of the disclosures. Okay. The question is, what year did he say that? And I'll spare you the agony. The answer was 1994. So 20 years later, we're still talking about the issue. And I really echo what Cameron just said. We're all in this. This is not something that any single firm or regulator, we all have to work on this issue. And technology probably provides some opportunities. Cameron suggested, there's things that we can do now. But I worry about two things. One is a lot of our highly technical disclosure, we're playing defense, not offense, which ties to your communication strategy. So we have a lot of highly technical disclosures that I think do more to confound the reader than inform the reader, kind of thing. And the second is that the key messages get lost in the volume. It's sort of like key things that are hidden in plain sight. And the analysts figure them out. They zero in on them, kind of thing. But I think there's a lot that we can do, and it costs a lot of money to produce all of this. And so I'm encouraged with what Cameron said, that Cameron's position, and some of the developments that are going on, both the United States, where the SEC looks like the new chairman has got an initiative in this area. But we all got to work on it together.
And the standard setter acknowledges this too. The IASB does have a project going on in this area. The one example that came to mind as we were talking about this morning was a presentation that I heard from the controller of Intel talking about this topic. And she was saying that the pension disclosure in their financial statements is 7 pages long, and the R&D, inventory, and capital assets information was a half a page. Yet that's their whole business. So do we have the right balance of disclosure in our standards? To me, that was an interesting observation that she had made, and I wonder how much of that is going on in our capital markets as well in terms of a lot of disclosure, and how much of that could perhaps be avoided if it wasn't material.
Well, your comment about taking these as communication vehicles to help investors allocate capital, make investment decisions, I think we've lost track of that versus the compliance side. But to change that, you're right. I think all the bodies need to be working in unison. And I'd even say as auditors, I mean, right now we're required to report, immaterial disclosures to audit committees. And they go, well, why is that? Why are we not compliant? Let's put it in. So all of us need to work together. Brian, as a regulator, any?
Well, no, I share Cameron's concern and the volume of what you have, what's relevant, what's not. I mean, I mentioned the audit, the expanded audit report. I think that's trying to get back to what is the relevance of what's in the financial statements. What were the key audit risks? So I think this is a challenge. I think, though, as we live in a communication age, if you like, an instant communication, I think you've got to not only look at the relevance of the 12-month statement, the annual report. What about the quarterlies? More and more investments are made on the quarterlies, and that's not required in all jurisdictions today. Auditors don't really spend a lot of time on that. They do a quick review. I think in terms of Cameron's thing, I think, we can fix some things in the financial statements. I think maybe a broader question is it the right information being communicated? And is it on a timely basis? That's probably a broader topic and more of a challenge, but I think somebody at some point has to really think about that very carefully.
Well, what I heard certainly amongst this panel is a consensus that something needs to be done. Sounds like some things are happening on the regulatory front, but I'm harping back to Jim's comments. This has been tried before and nothing's changed. So it really is what it's going to make a difference. And I think actually audit committees can be very helpful in driving that forward. Even when you think about your year-end disclosures, I think this year is a bit locked in, but think about it for future years. One other thing I wanted to touch on is the use of non-GAAP measures. And a lot of people say that the P&L has lost its relevance. It's become a dumping ground. It doesn't really show the performance. So of course they come up with their own performance indicators, and EBITDA and other things are used out there. The question is, how good are the standards? Like as an investor, when I look at those, what is the credibility behind EBITDA and all the adjustments to it? And what should we as audit committees and audit committee members be doing? But first, maybe Cameron, what's happening on the regulatory front?
Well, non-GAAP measures has been a topic that's been kicking around for a while in the regulatory world. We have some expectations in Canada that the Canadian Securities Administrators has published in a notice, it's 52306, that talks about what to do when you're using those measures. Make sure you have a reconciliation. Make sure that you use a name that's meaningful for the non-GAAP measure. Make sure you don't provide it with any more prominence than the GAAP measure. So we have some guidelines, some boundaries. And internationally, we are almost final in coming out with a similar guideline that we published for comment for consultation, and now we're assessing those comments. So internationally, globally, we may be able to move the bar to get some consistency in practice. So you mentioned EBITDA. That's an interesting topic as well, because sometimes we see that in the financial statements as a subtotal, and we see all kinds of subtotals these days under IFRS. The standard setter has now come out with some amendments to IS1 to say that if you use those subtotals, make sure and do some of the things that I just said. Make sure that the label is meaningful. So if you use EBITDA, make sure it's earnings before interest, taxes, depreciation, and amortization, and not a bunch of other stuff, restructuring, pension, other things that are excluded from EBITDA. Make sure we use those words appropriately. Make sure we label the subtotal appropriately. And make sure it's used consistently from period to period. Let's give investors a fighting chance in assessing these non-GAAP measures. We're not saying don't use them. We understand that they are useful to investors in some way, but tell them why it's useful to them. Why does management need that measure? What do they use it for? And what should an investor use it for? That would be useful.
Just one last comment from panelists on it, and it's about what audit committees might be doing around those measures. Obviously, if it's in the financial statements, the auditors look at it and report on it, so you have some comfort. If it's in the MD&A, the auditors don't typically look at it. If it's in other disclosure documents, there's very limited look at it. So if that is a key performance indicators, what should audit committees be doing around that? Jim, your thoughts and reaction?
Well, I think there's a lot of these non-GAAP measures are very critical, and there's a lot of industry-specific measures. Retail same-store sales is a critical measure, drives the market, and yet there is no standards for the computation of same-store sales. In telecoms, it's ARPUs and utilization statistics in hotels, and every industry has some very key industry-related metrics. The audit committee needs to understand the basis, and it needs to understand when there has been a shift in consistency in those, and perhaps maybe they should be engaging internal audit or external audit to be conducting a review of those critical measures, because these are very important metrics. Very important metrics for assessing performance, and somehow we got to sweep them in to make them not second-class citizens, but recognize their importance and give them appropriate level of assurance that they're done right.
So I think that's the second message here, obviously around reporting, what can you do on that front, but also to the extent you are using non-GAAP measures, they're key performance drivers, what comfort do you have around them, and what role should the audit committee play around that? It is time to put you to work now, and we do have a question. What are the key initiatives your boards could take to improve the quality of corporate reporting?